All right, my friends, the irony of all ironies today. I did a tutorial on Ed Jones, my take on Ed Jones, and I gave him my thoughts, good and bad. And then the irony was, all of a sudden out of nowhere, this piece of paper comes to me from, let's just say, a little birdie, from a life insurance policy that Ed Jones was soliciting to this group of employees using variable universal life in a life insurance retirement plan construct, an executive bonus plan. And I have to laugh. How is that a divine intervention? I don't know. Let's talk about this, because this is a VUL, variable universal life, and I'm not a fan of VULs. I sold one in my career, one, that's it, to a young lady, Central Virginia. She's probably 28 or so, in good health, and she had a couple kids. And I remember I didn't know, and she already had the policy. We switched out from a policy to a new policy. I can't remember why, to be honest. It was a long time, 2004. And anyway, long story, she was only paying like $250 a month, but the illustration looked great. And that's the thing with VULs. The illustration always looks pretty good. I've yet to see one come out the way it looked like on the illustration. I've yet to see that. Doesn't mean it can't happen. I'm sure there's a guy out there saying, my clients have illustrations that look great. Yeah, I bet. We always hear that. I had a guy debating me on life insurance. I'm going to show you something here in just a sec. He said he was getting Mass Mutual was paying 6.5. I said, well, let's see the cash value. What's the cash value after 10 years? So you put $100,000 in, the cash value is $95,000. I said, whoa. You said you were getting 6.5 interest on your $100,000, whatever it was, $100,000, and yet you have less than your initial deposit. He goes, yeah, those are surrender charges. I said, so you can't say. And we'll talk about it here. All right, so let's talk about this. So in this case, the proposal was you had a 45-year-old male, non-smoker, who's going to put $20,000 a year. And look, I haven't really crunched these numbers yet. I'm just going off what I'm seeing. I'm going to fly by this and see what we look at. I don't know. But just if you were sitting in front of me as a client, you say, hey, I got this proposal. What do you think? This is how I look at it. I said, okay, so you're putting $20,000 a year in for 15 years, all right? So your total contributions of $300,000. Actually, I probably should write that down up there someplace. So your total contributions, $300K. You see that? Yeah, sweet. Total. All right, so your total contributions are $300K at $20,000 a pop. Now your initial death benefit is $474,000. All right, so if you died tomorrow, you'd have $20,000 out, but your heirs will get $475 or $474 in. Does that make sense? So you're going to net in that case $454,000, which seems pretty good. But if you had a term, it'd be a whole lot better. But we won't talk about that yet. I will get into that in just a second. But just, so your internal rate of return on the death benefit on a $20,000 initial deposit into this account is significantly high. You definitely, if you died tomorrow, you'd be glad you got this product. You won't because you're dead, but your heirs will. All right, so in this case, after year one, now we're also getting a rate of return. We have a hypothetical rate of return of 6.5%. ROR, but with the portfolio fees, the expenses is going to be 5.61 after 0.89 annual expense charge. All right, so let's see what we're looking at here. So now we got $20,000, and after the first year, we got $19,065 in it. What's this 740? Oh, okay, yeah. So we got cash value of $19,000. Policy value, the cash value, $19,065, but your surrender value is only $740 because the huge surrender charges they'll charge if you were to take this out, because they got to pay the commission. They're paying a commission to the guy who sold this to you, and you might not see it on the front end. You're not going to say, oh, you're 5.5%. It's on the back end, and so they're going to recoup the commission if you sell this guy, take this guy out. So your $20,000, you only have $19,065 in cash value. But if you were to walk away money, this is going to be walk away money. It's only $740, and yet you got a 6.5 or even a 5.61% rate of return. Where is that? All right, so now we go 5 years down the road. And we put in $100,000, and we have $104,000 as they call it policy value. I would call it cash value, but they call it policy value. But you only got $88,000 of walkaway money. So you put in $100,000, 5 years at $100,000, and you only got $88,000 to show for it. Now, you do have a $560,000 death benefit. Now, here's what I want to talk about. For a lot of life insurance companies, and everyone is a little bit different. From my experiences, you have two policies. You got a policy A and a policy B. All right, and so a policy A is you have a fixed death benefit. A whole life will be a policy A. So your death benefit is $500,000. At your death, your spouse or your heirs, whoever it is, will get $500,000, which includes any cash value that you have in there. So you get a $500,000 death benefit, of which $200,000 is your own cash value. So $200,000 is yours. So at your death, we'll just say Charlotte, she'll get $500,000. $200,000 is my cash value she's getting, and $300,000 is from the insurance company. Does that make sense? So every year my cash value builds. So I got a flat death benefit, $500,000. Every year my cash value builds is less and less insurance amount the insurance company has to pay. I hope that makes sense. That's a policy A. A policy B is I get a $500,000 death benefit, but I have a cash value of $100,000. So at my death, Charlotte gets the $500,000 life insurance plus the $100,000. So in this case, the cash value goes on top of the death benefit. Which one do you think is more expensive? Well, inherently, the policy B is going to be more expensive because the insurance company is always on the hook for that $500,000. Always. They know if I die tomorrow or if I die 25 million years from now, they got to pay $500,000. In policy A, they're only on the hook for declining amount as my cash value builds, and to the point that there's a little what's called a corridor when your cash value will have to start bumping up the death benefit, because for it to be a tax-free life insurance, the cash value can't go above it. It's got to be, they'll start building up the corridor to make it to continue to be a life insurance policy by IRS code instead of a investment. And so for that, there will always be a little bit more. The death benefit will always be a little bit higher than the cash value. But either way, the life insurance company isn't on the hook for much at that point anyway. So that's policy A. Policy B is you have your death benefit plus this. So let's take a look at what do you think this is. So here we have initial death benefit when it started out of $455,000 was the initial death benefit. So let's write that down here. Let's see, can you see that? 455, yeah, kind of. DB. Yeah, you can see that. All right. So 455,000 is the initial death benefit. So let's fast forward 5 years. All right, so now we have 455,000 is our death benefit, and then we have a surrender value of 88,000. Let's take 455 plus 88. And lo and behold, we're looking at right about $560,000, 455 plus 88 death benefit after year, what's that, year 5? Yeah, there you go. So we're taking, that's right, almost exactly right. So basically we're having this plus this amount right here. What is it plus that amount? Hold on just a second. It might be plus this, 455, because it's not really a surrender value. Yeah, here it is. Okay, so we're taking our death benefit, our initial death benefit, 455, which is staying flat, and we're adding this cash value to get you a death benefit of 560. Hope that makes sense. So this will be an option B, which is going to be more expensive because the life insurance company is always on the hook for this 455. So we take 455, we add your cash value to get a death benefit of 560. Fast forward 10 years. You're still putting $20,000. Now you put $200,000 in this puppy. You got $238,000 in cash value, of which you still have a surrender charge of $3,000, but it's getting close now. And you got a death benefit of $693. But that death benefit is a third of that's yours. You got $455 from the insurance company, plus $238 from your own pocket, which is, again, this is your money. Plus, and that will give you a death benefit of $693. So while this looks fancy, it's really not that big of a deal because a good amount of that is your own money. Fast forward to year 15, and you got $417,000 of cash in there, and there's no more surrender value, no more surrender charge. So this is all yours. And I think that's the first year that the surrender charge stops in year 10. Okay. So after year 10, there's no more surrender charge. That means they basically were able to recoup the commission they paid to the broker. So you got $417,000 plus the $455 death benefit, and your life insurance component, your death benefit, is $872,000. So you get hit by a bus, your spouse is getting this, and again, I hate saying your spouse. It could be anyone. It could be me. It could be anyone. I got to do another video on the unholy trinity of life insurance. But you get hit by a bus. Your heirs get $455 from the life insurance company plus your cash value to get a total death benefit $872,000 tax free. All right. So now let's fast forward. Let me erase this because this is where they get kind of cute. How do I want to do this? Now we're not going to do any more premiums after year 15. All right. So year 15, we're not doing any more premiums. We've already, I don't want to say pay up, but we're stopping our premiums, and we're just going to let this sucker continue to grow. And we're going to say, I hope you got to look at my little weight room there. Did you see that? I messed up. Wow, that was kind of funny. My wires got in the way. Okay, there we go. Is that still okay? Good. All right, so in year 25, all right, so now let's go year 25. We have a no more premium, but policy value, cash value of $654,000. Again, there is no more, the surrender value is gone. There's no surrender charge anymore at all. So now we got a cash value of $654,000. We got death benefit. You want to take a guess what the death benefit will be, my friends? It's going to be, well, in this case, the death actually, okay, in this, I got you. No, let me scratch this a little bit. Let's go to year 24 because year 25, something happens. Okay, I see what's going on here. So in year 24, I'm going to make sure I don't do that again. All right, so year 24, we got a cash value of $672,000. We're going to say $673,000. And we got a death benefit of $872. No, $872. Huh, now that's odd. The death benefit stays flat at that point. See it? Why does the death benefit stay flat? I don't like that at all. So the death benefit is now, so basically if you died, this is no longer, 455 is no longer the death benefit. If you died, your spouse or your heir is getting $199,000 from the insurance company because this is all yours. So your life insurance is $199,000. I mean, boggles the mind. All right, anyway. All right, so now in year 25, let me get over here again. You take a withdrawal of, how much you take out? $54,000. How do I want to put this? So we withdraw 54,000. I don't want to do that. Let's do it. Withdraw 54,000 roughly, and then we got a cash value of 654 and a death benefit 817. All right, so we took out 54,000. We still got the 5.61% on the remainder of that. So 673 minus 54 times 5.61%, and our death benefit fell, and our cash value fell. Now it's interesting. The death benefit fell pretty much a lot more than the cash value did. Isn't that interesting? So let's see what happens in year 30. We'll keep running this. So year 30, we have 500. Man, this is weird. Now we got a surrender value again. Why do we? So the surrender value comes back. In year 30, you got $577,000 of cash value, but you have a surrender value of $547,000. What the hell is that? Oh, because you're borrowing. Now you've got a loan. I see. Because now you got a loan outstanding. Because this is I'm talking about. It's way too. There's no way this guy knew what he's talking about here. All right. So anyway, year 30, we got 577 of cash value. Now we're not making any more premiums, and our death benefit is down to 576. Now we've taken another 50. We'll just say 54,000 again. All right. So we've taken 54,000 times, what's that? 1, 2, 3, 4, 5, 6. Let me get my trusty calculator. 54,000 times 6. And the reason there's a surrender value is because you borrow. Now instead of taking a withdrawal, you're borrowing in a tax-free loan because of return of principal essentially. And because you're borrowing against your life, it's not even a return of principal. It's just a loan. I mean, it's just literally what it is. And because it's a loan, it will reduce the amount of cash value you have, because at your death, the heir has to pay that back, if that makes sense. I know it's confusing. Another reason, the more confusing, the more to stay away. But in this case, we got a loan outstanding, and that means we got 50. What was I going to do? Oh, so we taken out 55,000 or 54,000 times 5 times 6. We've taken out $324,000. So I see what's happening here. So we've taken $324,000 out total. So of which $300,000 is our principal. So we've withdrawn our principal. I gotcha. So in this case, that is our principal. We did that for 5 years, basically 5.5. And then once we withdrew our principal, we're withdrawing. We're taking the loans out as opposed to taking from the principal. The principal is always gone, already gone. So now it's all cost. But now it's all a tax-free loan. Does that make sense? And now we're getting real dicey, because if this sucker blows up on you, that's a tax nightmare for sure. Okay, I see what's happening here. So now in this year, because we have $324,000 is what we're drawing at, $54,000 a year, and our principal is $300,000. Remember, we put in $20,000 for 15 years. All right, $20,000 for 15 years is $300,000. That's our cost basis. And this is what we took out more than our principal, which is going to be a loan. And that loan comes out, which will reduce the cash value by the amount of the loan. I know it's confusing as all can be, which is why I should stay away from these things, because these are confusing. But anyway, so now our cash value is reduced by the amount of the loan. But we just got our principal back. So what these guys are saying, though, let's keep going forward. Now it gets even worse. Let's see, I got to spray this guy down. So remember, it gets even worse, because we're taking $54,000 out. I'm sure the guys say, "Oh, you're taking $54,000 out. That's real money." No, it's not. It's not real money. All right, I mean, it's real money, but it's your own money. All right, so I'm going to show you something different here in just a second. All right, so we got $54,000 out. Now we're going to go to, we'll just end this guy in year 80. All right, so I mean, year 40. Year 40, we got 800. The policy value. No, the surrender value is 209. The death benefit is 254. Okay, so that's it. So at the last year, when you're 85 years old, you have $209,000 of cash value with a death benefit of 254. That's it. All right, now we're able to take out 54,000, 15 times. So you're able to take out 54,000 times 15. So you're able to take out $810,000 total withdrawal. Well, it's actually a loan / withdrawal. But here's the problem. You have a death benefit. Okay, yeah, that makes sense. So you're able to take out a lot. I mean, so you took $810,000 out. Over the course of 40 years, you're able to take out $810,000. Again, this assumes everything goes according to plan, which it won't. All right, now, but the problem is when you die, your heirs will get this right here at this stage, because they're going to sacrifice. They got to pay back the loan. And the actual policy value is worth $897,000. But because you have huge amounts of loans outstanding, because you've been taking out $54,000 a year for 10 years, you got to pay all that money back. So at your death, this is what your heirs get, $254,000. Now you were able to take out $810,000. All right, so you put in $300,000, and you're able to take out $810,000 between years 25 and 40. That's what's that? 5, 10, 15, about 16 years. All right. So now let's do something. Let's just take our trusty calculator. All right. And I'm just going to do a simple, real quick. All right, so we're going to take our trusty calculator. And I'm going to do 20,000 a year payments. 20,000 is our payment. We're going to do it for 15 years. 6.5% interest rate. And again, I'm just doing index funds because we're not going to have fund charges. Doesn't make sense. And I'm going to do it for, what do you say, 15 years. All right, so, let's see. Let me make sure I got that right. Yeah, okay. 20,000 payment. Oops. Zero present value. 20,000 is our payment. 15 years, 6.5% interest, zero present value. We have 515,000 after 15 years. Okay, so now I don't make another payment at all, and I wait another, what's that, 10 years. So let's wait till year 25. So 515 is our present value. No more payments. 10 years, 6.5% interest. Oops, 10 years, 6.5% interest. All right, so in year 25, I got $966,000. All right, so in this case, we're going to take 5% a year out of this guy, and that's roughly, that's a little bit less than 50. Well, I can tell you times 0.05. We're going to take 48,000 a year. All right, so that's what we're going to take, 48,000 a year at 5%. No surrender charges, complete access to our funds whenever we want, the entirety of the account, no surrender charges, no relying on an insurance company, because again, this is just, I don't even know what the insurance company fees are, to be honest with you. I mean, this is just saying illustrated values based on current non-guaranteed policy of 6.5% hypothetical rate of return, minus net after fund expense charges, but the insurance company has charges too. And that might be in the initial part of the policy versus surrender charge. I don't know. I highly suspect it's not, but I don't know. So here we're going to take $48,000 a year, all right? And we're going to say we got 966 is our present value. 48,000 is our payment. Oops, yeah, there you go. And we're going to do it for 15, what do you say, 15 years? Yeah, 16 years. And we're going to still get 6.5%. And here our future value is still going to be 1.2 million. In year 40. I just, and I'll even do that again just to make sure I got it right. So we got 966 as our present value. All right. And then we're going to do a payment of 48,000. And you got minus it because we're taking money out. We're going to do what I say, 15. No, we got 5, 10, 15, 16 years. And a 6.5%. Yeah, 1.2 million. It's actually almost close to 1.3. So here we're getting, we're getting 48,000, which is 6,000 less than what they're got, but we're gonna have 1.2 million left over. I mean, it's not even, the other one you only had 209. Now let's just go back and say we don't want 48,000. We want 5%. We want 54,000. So we got 966,000 present value. We're gonna take 54,000 a year out. All right, payment. And we're going to do, what do we got? 16 years, 6.5%, 1.08 million. I mean, this is real money, real flipping money. I'm trying to think what the arguments will be. Well, the other one grows tax-free. Oh, okay, that's minimal. I mean, because if you put it in index funds, there's not much tax to begin with. I mean, you got a dividend yield of 2.3%. Shouldn't be much in terms of capital gains. It's tax-free to your heirs. Well, if it's a non-IRA account, it's tax-free to your heirs too because of step-up basis. If you die in the first front part of this, that's what they could say, in the first 5 or 10 years, you could get a pretty significant death benefit. Well, hell, buy a term policy for $100 a month. I mean, I got a term policy. I pay $1,300 a year for $1 million term policy, my friends. And I took it out when I was 46, 47. All right, so a 45-year-old non-smoker, I mean, you could buy $1 million term policy for a little bit more than $100 a month, man, for $1 million. I don't see the benefit in these things at all. Now, I mean, I guess, well, Josh, you're showing a 6.5% as if there's no fund cost, and we're showing fund costs of 0.89, so we're only getting a net of 5.61. Yeah, that's your own. I hate to say it, that's their damn fault. That's their damn fault for putting in high expense funds. Josh, 0.89 is in a high expense fund. It is relative to a 2 or 3 basis point index fund. Anyway, we're talking 1.2 million, or, by the way, just playing some carrots. Oh man, carrot tender sweet. Oh, I can't wait for these suckers to grow. All right, so we got it's actually about 1.3 and 1.1, but I'm just rounding down. So when you die in year 40, your death benefit is in the 7 figures. And you have either $48,000 a year or $54,000 a year. Oh, but there's taxes. Yeah, I mean, I get that. There could be some capital gain, but you still have what's called cost basis. So you still are able to take $300,000 out tax free because of specific identification of your shares. Okay, but even that was just okay. I mean, it's like I pay 15% capital gain tax. If even that, depending where my tax bracket is. All right, so we knock off 15% here. It's still $850. No, it's still $900. Anyway, I don't see it, my friends. This is I hope this makes sense. I know there's a lot going on here, but if it's a variable universal life insurance, I just don't see it. I don't. Too expensive, way too limited on your ability to get access to your funds. And there's just other ways to do this a whole lot easier, a whole lot cleaner, a whole lot less complex with actually maximizing your net proceeds. So I hope this helps. Part 2 of our Ed Jones things. We'll see you next time. Thanks now.